Right. So continuing with the previous theme and moving into the crude oil markets, ultimately, there's probably going to be a surprise throughout 2019. If you're not aware of it, there's an oil war going on between different crude slates, mainly between heavy crudes versus light sweet crudes. And so light sweets right now seem to be where the market's going to position, and they seem to be the winning bet going into 2019, and then going into that recession in the U.S. in 2020, where the U.S. is actually able to switch its domestic consumption over to export-led growth, which will be driven mainly by the production in crude oil, liquefied petroleum gas products, NGLs, as well as liquefied natural gas that the U.S. is going to be able to export at a very, very competitive pace, which will also help close the U.S.'s some of the U.S.'s trade deficit. In combination with the ability that hopefully China opens up its market in 2020, which is what the expectation is given the policy that China had in the 13th five-year plan. So 2020 is sort of kind of when everything opens up. So the U.S. recession will actually be a good thing because it allows the U.S. to rebalance the economy, and it allows the U.S. export sector to take on a significant portion of that growth in terms of exporting petroleum products and crude oil to regions like India and China, and in general just East Asia. So the crude oil market is for 2019. I think there's going to be a lot of surprises, and I think the prices are going to be substantially higher than where people are anticipating at this point in time for 2019. So what I have right now for quarter one in 2019 is a price of about $65 a barrel, and that's a WTI price. Obviously, we're not very close to that at this point in time. But for quarter two, I see WTI at $70 a barrel. Quarter three, I think it's going to hit $80 a barrel. In quarter four, I have it at $75 a barrel. So in Q2, you typically have the maintenance season is over with. Refiners start to pull in crude oil to process, and you typically see prices move higher during the second quarter and the third quarter, which captures the start of the spring into the summer driving season, and then you have the tell-off during the fourth quarter when everything starts to when demand starts to lessen a little bit. So I think that's going to be pretty similar this year, but I think the price is going to rise substantially. And so if you listen to my GDP base case scenario, I said that I expect the U.S. dollar to be strong in the first quarter and the second quarter due to the U.S. position in terms of growing at a faster rate for those first two quarters in 2019 than the U.S. trading partners, which is going to put significant pressure on the U.S. dollar in terms of creating upward pressure on the U.S. dollar. But that eventually is going to loop itself into a feedback loop where the U.S. economy is going to grow at a slower pace in the second half of the year in Q3 and Q4 of 2019. That weakness in the dollar is going to be translated throughout the global economy, and it actually acts as it lessens the tightening that the Federal Reserve, given my May 2015 one hike that I think they're going to do of 25 basis points, that gets us up to a federal funds rate of 275 basis points. So when you look at the crude market, it's going to be heavily influential, and I think it's going to drive some of the inflation expectations that are likely going to change because the price of oil is going to increase substantially. So where I go from 70 to 80 for Q2 and Q3 in 2019, that's going to have a huge impact. And then I'll go further out to 2020. Obviously, I have prices declining in quarter one to $55 for WTI, and then quarter two, $57, and quarter three, $58, and quarter four, $58. And that's going to just be due to the fact that demand's going to be softening a little bit, and you're still going to have supply coming out of the U.S. and some of the other light sweet producers like, who knows, like Libya, Nigeria, Angola, and light oil coming out of who knows what the situation could be in Iran in 2020 as well. But the U.S. is going to be in a great position in the sense that they're going to be producing almost 12 to 12.5 million barrels a day. And then 2021 prices probably start to recover again to $60 I have for Q1. For Q2 I have $65. For Q3 I have $68, and for Q4 I have $70. So the prices average for each of the years. In 2019, it averaged about $72.50 for WTI. For 2020, $57, and for 2021, $65.75. So what are some of the reasons that's driving a lot of this? One, the U.S. is strategically advantaged. In terms of offering energy and agriculture exports, as well as when China opens up its economy in 2020, the U.S. will actually be able to benefit from offering not only financial services, but tourism services, as well as educational services to the Chinese. So the U.S. Should be able to grow its service surplus with the Chinese significantly more, and also close its current account its trade deficit with the Chinese through the export of petroleum products and other things. So the U.S. produces a ton of sweet oil, and that's always priced at a premium to other heavier sour grades. And part of that has to do with the fact that if you run light sweet crude through a refinery, typically you get a higher petroleum products of gasoline and diesel, which obviously the Chinese economy, having 1 billion people and about 100 million people into the middle class, are going to be heavy users of cars, and that's going to obviously increase their intake of crude oil. Same thing with India as well. So China and India are going to be the major importers of oil going forward, and the U.S. is going to be the major exporter. So you can see where that's shifting the current account surpluses from countries that were running deficits to countries that could potentially be surplus countries by mid-2020s. Part of that is going to be beneficial. I guess the other thing I'll just quickly say for the global crude slate wars that will heat up in 2019, and the reason I'm saying that I think prices are going to be higher for crude oil really stems from, I think the Saudis are ultimately going to have to do a surprise production cut. So they were initially targeting about 1.2 million barrels in December. Clearly, at this point in time, with the aggressiveness of U.S. shale, they're going to have to cut again if they want to raise prices for their heavy grades. So what you'll probably notice is that some of the spreads between light sweet crude and heavier and medium sour crude, like the Brent-Dubai Spread, is probably going to narrow in Q2 of 2019 into Q4 of 2019, and that's going to be driven mainly by the cuts from the Saudis in April at the start of Q2. Brent-WTI, which is kind of in a battle with other light sweet crudes in the globe in terms of getting the U.S. exports out. Brent-WTI is still going to have a fairly wide spread, at least for Q1 and Q2. Before later probably tightening at the end of Q3 and into Q4. The winner obviously is going to be U.S. barrels traveling out of the Gulf Coast into the Asian basin, which is again India, China, and then some of the other East Asian countries that actually take in oil, like maybe South Korea, Japan. So it's going to be a very interesting market. And then I guess the other thing too is that the spread between U.S. light sweets and Middle Eastern medium sour to heavies, the spread will also narrow. So the WTI Dubai Spread will probably narrow, but remain relatively wide, given the fact that U.S. is still substantially cheaper going forward into Q2, Q3, and Q4 than dated Brent. So the other thing too that could probably drive U.S. exports further is some of the things that are taking place in the tanker industry with lower sulfur, and where they're going to be favoring more light sweet crude that comes out of the U.S. and some other places. There's also probably a battle between OPEC light producers like Libya and Nigeria. It's kind of interesting that at this point in time they're strangely seeming to always be in a situation where they're unable to produce light sweet crudes, which obviously increases the premium versus what you would have for heavy sour, which makes heavy sour a little bit more competitive. But after the Saudis do the production cut in April of 2019 Q2, that's probably going to change, and those spreads are going to narrow significantly. But anyway, and then I guess recently, if you throw in the Venezuelan sanctions, these things sort of kind of seem to be offsetting to some degree. but it ultimately favors higher prices throughout the course of 2019. And again, the other tailwind ultimately is going to be the weakness in the U.S. Economy as the U.S. decelerates into the second half of 2018, which means that the dollar is going to have to make that adjustment, and the dollar is ultimately going to be weaker. So that's likely to have a significant impact on inflation expectations, which are highly correlated to shifts in oil and energy prices. So again, if you listen to some of my earlier videos, I had a Federal Reserve outlook in terms of tightening and what they're going to do for the remainder of the tightening cycle, where the market really doesn't see a hike taking place this year, and the market actually sees a rate cut in 2020. Where I'm saying that they're most likely going to hike rates during the second quarter. And part of the reasoning behind that and the logic behind that has to do with the fact that I think in April the Saudis are going to make the production cuts, and that's going to increase the inflation expectations that have been anchored around about 2%, but it could increase that temporarily, which would give the Fed room to actually do one additional hike, because they really want to do one hike. They wanted to do three, but they ultimately still want to tighten at least one more time. And some of that has to do with just the Federal Reserve Bank and the PBOC in terms of what's ultimately going to happen when China opens its financial accounts. So the Federal Reserve tightening actually is just as odd as it may seem, it actually is probably a more beneficial thing, because a lot of that capital that will eventually flow out of China is going to look for interest rate differentials between China and the U.S. And if the U.S. differentials in terms of real yields are more favorable, a lot of that capital is likely to flow back into the U.S. But that's a story. That's a whole other conversation for another day. But that's ultimately where I see oil and how I see the crude market kind of working itself out in 2019, which again, if you listen to the previous videos, goes along with kind of my base case scenario. The other thing I guess is that obviously that would probably, and not that I want to go into stock ideas here, but it lends some credibility to where markets may be in terms of energy stocks probably benefiting in the second half of the year, are going into Q2 when some of those buybacks come in, and also the price of oil starts to rise. So so the next video is kind of just a close out of this video, and sort of kind of gives an idea of what the increase in commodity prices will have on emerging markets, and how you'll probably likely see on dollar weakness some capital flow out of the U.S. Into emerging markets, which is already starting to take place, but it's typically hot flows that follow hot money, and they're going to be looking at yield searching behavior in the sense that they're going to be aggressively trying to capitalize on the interest rate and growth differentials that are going to be taking place as the Fed's policy remains more accommodative throughout the end of Q3, Q4, and into Q1 2020 and into Q2 2020. So that's going to be beneficial for some emerging market currencies as well as some emerging market countries. And I'll talk a little bit about those in the next video. And then I'll also go into I'll try to do is tie in some of the geopolitical things that a lot of market participants don't tend to think about that are associated with commodity markets and the U.S. sphere of influence, and some of those things and how they relate. So and then the video after that we'll go into the 10-year Treasury and the twin deficit, and how the widening of the net exports is going to drag on GDP throughout the year, and sort of what kind of effect that's going to have on absorption of Treasury issuance at the same time while the U.S. Federal Reserve is reducing the size of their balance sheet. So if you like the videos and want to stick with them, those will be the next couple, and thanks for listening.